Hello, everyone. Welcome to our next fintech interview. Today, our guest is Josh Lawler, a recognized lawyer from the United States of America. He is a partner at ZuberLawer, expert in finance, M&A and securities legislation, actively involved in the field of digital securities. Hi, Josh. My name is Boris. I am co-founder and the head of business analytics at Stobox. With me, we also have Ross, chief operating officer at Stobox and also our co-founder.
Hi, everyone.
Hello.
Josh, thank you for joining us today. Please, for the introductory, tell us a bit about yourself, what you are focusing on, and how you're involved in the blockchain and digital security space.
Absolutely, Boris, my pleasure. So as you mentioned, my name is Josh Lawler. I'm a partner at the United States law firm ZuberLawer in Del Duca, where I head our firm's new technology practice that basically is comprised of mergers and acquisitions, finance and commercial transactions, IP transactions in newer technology areas, including, of course, distributed ledger technology, or blockchain, as people like to call it. I've been practicing that space for about 4 years and interested in it from more of a personal perspective for maybe twice that amount of time. And really very fortunate that this particular technology fell out of the sky at the intersection of securities law and intellectual property, which is where I spend most of my time. Having studied the regulation, having traded some of the digital assets and read the white papers and of course traveled globally speaking on the topic, I feel I've got a really wonderful grasp of not only the regulatory in the United States, but in some other countries as well. And also the business models, the tokenomics, the personalities, the ecosystem in general. And I've done a pretty fair job of predicting where things are going to go, at least in our country from a regulatory standpoint, and very interested in where they're going in the future.
Thank you for the introduction, and it's great to have such experienced professionals with us. So let's start with the discussion of regulatory environment in the United States. So could you tell us where we are now on the state level, in the federal level, in terms of blockchain and digital securities legislation?
Absolutely. So in my humble opinion, my country largely messed this up badly. And I don't blame anybody for it. If you look at kind of the history, and I won't go into the whole thing here, but it's kind of a natural growth out of the fact that the SEC is designed to protect the Main Street investor and to preserve orderly markets. And they saw a mess taking place, so they stepped in to, in their view, clean it up. The problem that they have, as do almost all United States legislative and administrative bodies, is that they can't really move fast to change the rules. So they tried to, or not tried, they did squeeze this new digital asset and new paradigm into existing law. And you may or may not be familiar with the Howey test of the United States, but that came out in 1946. So to say it's a little dated is an understatement. And although at a surface level on an issuance, it can fit, if you get much beyond that, it doesn't fit at all. And we haven't worked through that. Now, the good news is that the government in general and the SEC in particular, I think, has gotten the message that this is the way things are going. Innovation is happening, whether they like it or not. Much like peer-to-peer music file sharing, a decade and a half ago, there's no putting the genie back in the bottle, so they need to adjust. And I think that they're slowly doing that at kind of the upper echelon levels. So not necessarily, the token project transactions, but the folks who are trying to do things like ETFs, which have been a problem, but who have historically been in the space in terms of high-level securities, regulatory understanding, and capital markets, are kind of breaking the ice a little bit. Things are happening. And I think that's going to continue to take place and loosen up. And the other factor that's working in our favor is, I think in 2017, there were a lot of profiteers out there who really were there to make money potentially at other people's expense. And we've kind of worked that through the system to some degree. There's still lawsuits being filed. The SEC is still doing enforcement actions, but there hasn't been a lot of new activity that I'm aware of jumping into the space, and that's a really good thing, because if we're not, poking the bear's not going to growl at us. Is one way of looking at it. So I'm hopeful, but it'll take a while.
And how do you think the legislation will evolve? Where is it everything moving?
Sure. So
On your
yeah, I mean, I'm smiling because like any other new technology, it's going to move faster than the government can. So I think it's incumbent upon those of us in the space to really push the technology while maybe slavishly following the spirit of the law and trying to kind of make it work for the letter of the law. But if we're really following the spirit of the law, then we'll find that the regulators can give a little bit more variance and room to operate. And at the end of the day, we're going to drag the government kicking and screaming into a good set of laws that will regulate this stuff, but it may take 10 or 15 years because they don't move fast.
Great. Josh, thank you for your answer. And I wonder, what is the demand for STOs in the US? So are there many projects who are looking for conducting an STO?
Sure. So it really kind of depends what you mean by STO. I'm going to break it down into two categories. There's the traditional financial product that's represented by a digital asset. So, at its base level, DeFi is effectively a debt instrument that's, represented by a digital asset, and therefore has the benefits of, being an immutable, transparent record and being able to be fractionalized and, peer-to-peer traded easily. And that's one thing. Share of stock would be the same thing. If you've got that, the demand on there is high and rising. People are figuring out the user experience, user interface, which is really the big thing holding everything back. And then as far as the regulatory goes, it's really the same thing as it was before. You comply with particular regulations, you are dealing with securities, and off you go. And that's moving pretty fast. I've spoken with a number of our larger institutions, Depository Trust and Clearing Corporation, which is where everything runs through right now. They've got blockchain projects that they're pushing. NASDAQ, I've spoken with several times. They're very interested. The Canadian Stock Exchange, same thing. All of the large custodians. So that's going. Now, what you may be thinking of as a security token in our business, which is the digital asset that has a value proposition driven by supply and demand, finite supply, growing demand. Not so much of that. The existing projects, you're starting to see a real separation between the ones that are real and the ones that are not, in terms of trading volume and how they're doing, which is great. But none of them are really safe from lawsuits for things that happened years ago, whether it's private or by the SEC. And there's not really much new that's happening. If somebody's trying to get a project out now with that type of a token, they don't use the token for a capital raise to begin with. And in our country, that makes a huge difference in terms of whether it's treated as a security or not. If you take away the investment aspect of it, then it becomes more like a commodity, or in some cases, even a consumer good that can fluctuate in value. There's a lot of emphasis right now on non-fungible tokens representing assets here, and things like garbage pail kids, collector items, NFTs, which was a big deal not too long ago. If those are sold the wrong way, they can be securities, but people are focused on not selling them the wrong way, which makes a difference.
Mm-hmm. That's we see nowadays that a lot of projects not running under security laws, so we have a lot of fraud on the market. And by the way, do you see the demand from the investor's perspective? So are they aware about this new type of investment in the US, and what are their concerns?
Yeah, so I'm smiling very wide because you're touching on a side project that I've been working on. I think, the investors know also that this is what's happening. And even, just a plain vanilla IPO is going to be a digital asset before, very long. So, there's kind of an open path to new types of financial products. One of them I particularly like is, tokens that represent fractions of income sharing agreements, which makes it a lot easier to monetize royalties, for instance, even though there's not really a company necessarily behind it. And it's a question of, marketing and conditioning the market to accept those types of things. And I and some other folks are really working on doing that. We're fortunate that, we can do that through private offerings to hedge funds and, other forward thinking folks, family offices, that type of thing. And that's really where it's going to start. So we haven't had that in terms of the, folks who are really working the traditional types of investment institutions, but I think we will, and that'll be a pretty fast tipping point when it happens.
Thank you for your reply and for your insights. And one of the questions concerning issues of digital securities is actually the cost, and especially the legal cost, which is a large chunk of all expenses on STO.
Mm-hmm.
So based on your experience, what is the range of legal cost of US-based security token offering?
Mm-hmm. Sure. So, without getting into actual numbers, the cost really should be, from a legal perspective, more or less what the cost was for a non-digital asset that's a securities offering. And that's going to range greatly from not very expensive if you're selling to one purchaser and they're a qualified institutional buyer, that's almost nothing from a legal cost perspective. That's venture capital funds and such. And there's template type documents, and at that point the only real difference is that you're recording things digitally rather than recording them on paper. If you look at something like Regulation A here, which is something that came in with Obama's administration, and that allowed somebody to raise $50 million through a effectively public offering to unaccredited investors. But the catch is that you have to run your offering document through the SEC for qualification. We know Blockstack spent more than $1 million doing that. I know we recently had ETF Abra was approved, and I don't think I'm allowed to say what the cost was because I don't think I'm supposed to know, but it was a low 7-digit number. That's got to come down. Those types of things should be, for a Reg A offering, $50,000 US is, that's pretty reasonable. For a private placement in the United States that's competitive, if you have to do a private placement memorandum, which for some of these you do, $50,000, $75,000 for something complicated is reasonable from a legal cost perspective. Now, my hope, and there are certainly some companies that are working on this, is that as time goes by, it's going to come down in price. It'll be somewhat templatized, if you will, and as people get more familiar with it, I think ultimately, the benefits of being on a distributed ledger are going to be such that possibly that cost can drop a little bit.
Hopefully so. New technologies always are at first stages more expensive, and then they got commoditized. You got competition, you got templates, and things become easier because for STOs maybe option even for smaller startups, not necessarily for bigger companies, but paying 50,000 in legal costs is just unbearable for them. They're using simple templates.
Yeah, it can be. Part of something we're looking at is really being able to use income sharing agreements to allow some of that cost to be backloaded to the point where you're actually raising the capital instead of upfront. For most of these, it's not that the legal cost is necessarily out of range. The problem is the timing. And I can tell you from our law firm's perspective, we're pretty locked into things like this, but we're not paid on a contingency based on whether the offering works, and we're not paid after the fact. Our position is typically by the hour and not in a position to finance the transaction. And I think there may be a little bit of a softening of that because of the ability to be a little bit more certain about how things go from a digital asset perspective. And a lot of that is, a different level of control over know your customer rules and anti-money laundering, being able to track things more easily. So, you know, fingers crossed. You really can't stop progress. And as you mentioned, the path is pretty well worn in terms of being more expensive and then commoditizing. We all know that. So it'll probably happen.
Yeah, I really love the idea about income sharing agreements and the flexibility they open. I really love the idea of income financing they open for business ventures. And one of the ideas we've been exploring, which I hope will kick in as well, is not only financing business venture, but also personal income sharing agreement. For example, when you collect funding to move to Silicon Valley or to do anything else that would improve your income, such as education, and then share part of your new enhanced income with investors. This has huge potential to unlock human potential especially in the developing countries, when people actually lack funding to go to the next level.
Yeah, I mean, you raise a really good point on the education space. You know, that type of an agreement is something that's been happening in the United States for a while, but it's a very poor financial product. So, you know, my law school alumni will call me, alma mater will call me up and ask if I'd like to sponsor a law student and, you know, keep some of their financial aid lower through an income sharing agreement where I receive a piece of their income, you know, after they graduate. And it's a horrible, horrible product. It's not diversified. It's not liquid. You know, I'm kind of stuck. If that guy gets hit by a bus, hopefully not, but if it happens, then, you know, I'm done. However, it's very easy with digital assets to securitize that income sharing agreement and do two things that are three things actually that are rather key. It becomes easy to pool them so that you can diversify the risk amongst people. It becomes easy to fractionalize them so that it doesn't have to be one person spending so much money to put one person through school. And of course, you can trade them. So it becomes a much more liquid type of asset. And, you know, one of the examples I really like to use, and I don't know if you're familiar with our school Juilliard here in New York City, but it's a school for musicians and artists and things of that nature. And it's, you know, very well known. It's been around for 40 years. And, you know, I talk about the idea of financing the graduating class from Juilliard each year so they can buy instruments. And, you know, then you take, you know, 10% of all of their income for 5 years or whatever it is, that, you know, somebody who's much better at math than I am will come up with, to, you know, set it up as a financial product. And the thing about that type of a product, if it's tradable, is that you get two aspects of it. There's an investment aspect, and then there's a patron of the arts aspect, where, you know, somebody may just really like, you know, music, and want to sponsor these young musicians. And, you know, for that matter, you know, I hadn't really thought about this till right now, but you could almost pair something of that nature with a non-fungible token that provides some type of collector value that you get with that investment. It's just, there's all kinds of different possibilities that open up. And that is exciting.
Definitely. I believe that currently we are at the stage of the market development where we need to create infrastructure for such kind of financial creativity to be easier for common folks, for financial engineers, and then we will see much more things done.
Yeah, exactly. You know, we'll have a successful proliferation of blockchain technology when the people using it don't know they're using it. It's kind of like a semiconductor or internal combustion engine. I think towards the beginning, there's a lot of attempt to explain blockchain to people, and you don't need to explain blockchain to people. It's hard to understand blockchain. They just need to know that it works, and they need to have faith in the fact, much like they have faith in an internal combustion engine or a semiconductor, that it works. And that type of faith is developed by having it come out and actually work, and have, you know, user interface and user experience, again, is really just critical.
Sure.
The big problem with the blockchain and the blockchain-based applications is that as they were created firstly by engineers and cryptographers, when going to people, they are explaining the technical nature and not the end value actually that people get. We've been actually speaking with one investment company that was promoting security tokens to family offices, and the family offices refused to invest because they said, well, we already invested in digital assets in ICOs and lost our money. And if you think that is very stupid, because those are very two different types of assets. But if you go explaining them as a technology and not its financial nature and value, then you end up with messing things up. So it really resonates with how the things will be moving as more business people and marketers come to the space.
Yeah, you raise a wonderful point. You know, when you get right down to it, you know, when somebody says, how do you regulate a digital asset? You know, what I'd like to point out to people is that what makes it a digital asset is just the way it's recorded. It's, you know, it's the medium on which it's recorded. So you might as well ask, how do you regulate paper? And when you think about it that way, it's like, well, you know, I don't know what's on the paper. You know, is the paper a share of stock in a company? Is the paper a piece of toilet paper or Kleenex? You know, is the paper top secret documents from the government? They're all paper. So how do you regulate paper is kind of a silly question. And, you know, how do you regulate digital assets is, you know, parallel. You know, you might as well ask, how do you regulate clay tablets?
Definitely. And many of our clients and followers ask us what state work best for companies doing STO in US?
Well, again, it really depends on what type of STO we're talking about. For the traditional financial product piece of it, you know, it doesn't matter a ton. There are certain states, Wyoming is one, Delaware is one, I think Arizona may have gone this direction, that will allow you to record a share ledger for a company electronically, which translates to on a blockchain. And we make a lot of use of that for certain types of securities. If you're talking about a offering of a traditional kind of quote utility token that has, you know, supply and demand type of characteristics. I know I said utility token, that almost by definition means not a security, but they are. I've always not liked that distinction. But if you're talking about that, you know, quite honestly, I would figure out how to do it not in the United States. That's where, you know, your Singapore Foundation, your Cayman Islands or Caribbean Foundation, what have you, starts to make a lot of sense. And, you know, there are certainly examples out there of companies that have done that. And, you know, a lot of the types of things that I do, I end up counseling clients from outside the United States on how to potentially get traded on a US exchange. And one of the biggest questions every time is, did you raise money in the United States? Are you still raising money in the United States or using your token as some type of a equivalent to a security to compensate people instead of paying them cash? If the answers to those are yes, then, you know, you're probably going to get swept up into being a security, even if you're not a traditional financial product. And that's bad. But, you know, the other way to do it is not as a security. And, you know, pointing to a couple examples, one that I love is, you know, Raven Coin, which is a top 50 token, I think, never did any kind of an offering. You know, it's a Bitcoin proof of work clone that was backed by Medici Ventures and just started releasing in kind of a grassroots kind of way, and it's grown. And they never did an offering, and it's a medium of exchange, and there's not really any argument about that. So, you know, it can be done. There's been a few in the last year. Cosmos did one. But, you know, I do feel it's somewhat tempting fate right now.
Yes, because to be honest, from our experience, when we were in the process of incorporating company, it wasn't obvious. Many companies are going to Delaware, while Wyoming is more attractive from the franchise tax perspective, according to which you need to pay in Delaware $85 annual from the 10,000 shares.
Yeah, it's you know, there's a lot of misunderstandings about that, even outside the digital asset space. Delaware is very popular because it has a certain type of corporate code that is very company favorable, particularly in the merger and acquisition context. And it's been that way for decades. And the Delaware Corp has become something where people just think, oh, Delaware is good, and don't really know why. So, you know, that kind of is what it is. And yes, they have a franchise tax, and there's, you know, ways of dealing with that. California's got a horrible franchise tax. We're $800 a year flat fee, which is just, you know, very difficult to work with. Wyoming has a lot of advantages. There are other states that also have a lot of advantages. And, that's just something that's one of the reasons to hire good lawyers, quite honestly. So I'll put the plug in.
Cool. Thanks for your reply. And I would like to discuss but the question of liquidity of security tokens. In particular, one of the questions, one of the ways I am passionate about is that actually for many issuers, especially for smaller or those who don't want to tackle with prospectus registration requirements and with disclosure, going to a regulated market to gain liquidity may not be the best option, but still they want to provide opportunity for private transactions and P2P trading that between their investors if clients if clients agree on that. So what are the pitfalls that can expect companies here? For example, do you need a transfer agent or you can process it yourself as an issuer?
Yeah, so there are a number of ways to do it, and none of them are easy for a very small company that doesn't have a lot of interest. The first thing that you need in order to have liquidity, and I don't care what kind of token you are, if you expect there to be trading or transfers, is there has to be interest. So if you are Joe's Pizza Parlor and you do a digital asset to finance another pizza parlor, and they're both in my hometown of Morristown, New Jersey, and sure, people in Morristown, New Jersey may like it, but to the rest of the world, it's two pizza parlors in northern New Jersey. It's like it's just not going to trade. So the first question is whether it's actually going to be possible from a practical perspective, even if you have the machinery in place. If the answer to that question is yes, and there's sufficient interest, then there's a variety of different ways to go. There are private kind of matching OTC type services. I know NASDAQ runs one, Shares Post is another. There's some other ones that are targeted to companies that are not as large, but more oftentimes biotech or natural resources and those types of things. What I'd like to see happen is that the reporting obligations become more manageable. And that again is something that I'm working on in our side project. There's a real disconnect still with what's required from a GAAP financial reporting perspective for securities to be, quote, public in the United States, and the actual things that matter for digital assets of certain types, and particularly, again, that supply and demand-based value piece. Right now you have to have a balance sheet and an income statement, and neither of those things is really super relevant if the question is how many tokens are in circulation, how many tokens are there in an absolute basis, and what's the market that they're used in, and how big is that market and how fast is it growing. That's what matters there. And yeah, balance sheet, maybe it matters because you hope that the organization is able to keep afloat in order to push the ecosystem, but that's it. It's not like a share of stock, and it's not like a bond. So this has not been a focus yet. It's actually, I've been thinking about that one for a couple of years. I'm not an accountant by trading, but that is, I think, actually going to be the last big roadblock, because what the SEC really wants and should want, because it's right, is proliferation of information so people trading can be on even footing. That's really, what this is all about. So we have to figure out what's relevant and possible.
Josh, what are the legal risks and pitfalls of US-based STOs and how to avoid them?
Well, again, if you're raising capital, and I'm going to put aside the traditional financial product because that answer is boring because it's the same as it always was. If you're raising capital with, a supply and demand-based value token, advice number one, stay out of the US for a couple of years. As horrible as that is to say, and I hate saying it because our country is falling behind from an innovation perspective, but that's the right answer. Or be ready to comply with the securities laws anyways. And again, pointing to a Blockstack as an example, that's what they're doing. They just filed a 1K which is an annual report here. And if you look at it, it provides financial reporting. And, one of the notes to the financial statements is, we don't think this is really relevant, but this is what the SEC requires. So, okay, here it is. And that was filed very recently. So, nobody knows exactly what the reaction to that is going to be. Usually in the United States, if there's issues of that nature, it comes out in one of two ways, really. One way would be if an investor sues. And when you've got problems with financial statements on public companies, that's usually what happens is a plaintiff's lawyer will come out of and they'll set up a class action or maybe several of them and they'll sue, and that's one way that it can play out. The other way it can play out is if there's not proper disclosure out there, the regulated broker-dealers and market makers and alternative trading systems are not supposed to actually trade it. They're not supposed to make a market for it. So if they do anyways, then it becomes a question for our self-regulatory organization, FINRA, which is responsible for regulating those types of licensed entities.
Thank you for a detailed response. It's interesting to see the lines between different types of assets becoming blurred and required more customized approach in regulation and in assessing them. One of the solutions, and actually it creates additional complexity, additional risks for a project launching new financial assets, additional costs for regulator as well on assessing them. One of which actually stills the innovation, making it slower. One of the things we've been thinking about and been working on is the concept and the promise of automated compliance that digital assets may have. So based on your vision as a practicing lawyer, do you think that automating compliance, given the complexity of potential products, is possible? And do you think that regulators will recognize the infrastructure that has automated compliance?
Yes and yes. It's not only possible, it's inevitable. If you look at how things are done now, you can regulate transactions on-chain or off-chain. And it's kind of it's a philosophical debate right now. On-chain requires something like an ERC 1400 standard, which is just loaded with all kinds of transaction restrictions to facilitate compliance with, US law, for instance. So, it might not allow transfers within a year of initial issuance. It might not allow transfers to countries that are on, the United States list of foreign countries that we don't do business with, those types of things. And that can be done through code on-chain, but it's very complicated and expensive. The alternative is off-chain, and it's kind of a know your wallet kind of system where in order for a particular type of token to transfer, it needs to check back to a centralized database to see if the transfer is allowed. Now, you heard me say the word centralized, obviously. So philosophically, there's some folks who don't want that to happen. However, there's a second layer of blockchain abstraction that's possible. And it's, again, more complicated initially, but at the end of the day, preserves the decentralized nature where, you've got the layer of the actual token transaction, and then you've got the layer of what was the centralized database of information deciding whether or not that transaction should be allowed to happen. So, again, it depends how cost effective it is to implement blockchain technology. I think it'll be a little while before that second version comes into play. For the moment, it's likely to be centralized. The other piece of it, and it's something, again, that I'm working on personally, is for the United States at least, and I think many countries, there's a tax reporting question that you really can't ignore. If your digital asset doesn't do anything other than, represent the rights to use some type of a blockchain system, then it's fine because there's no value distributed down the chain. On the traditional financial product market, though, that's not how things work. In traditional financial markets, you make money on your investment. So, that might be in the form of dividends, that might be in the form of, a repayment of a loan plus interest. There's a lot of different ways to do it. And those types of issues from a tax reporting perspective, I have not yet seen anybody do that or even theorize how to do it on chain effectively. Somebody has got to be responsible for sending the tax form out to, the government on one hand and the person on the other hand, so that they can pay their taxes. Now, in terms of automation, you think about it, that function I just described is just ripe for automation. If you think in the United States what the IRS will think about it, well, I haven't asked them, but my expectation is that they would love it because it makes their job easier. If they know that they've got a single source of tax forms for a particular type of asset and that it's going to be reported in an automated fashion, potentially you can even plug into an IRS API from that perspective and not even have to print the forms out. That's attractive, certainly. I think that that's going to be a given that happens. And particularly, as the US slowly develops the digital dollar, I think that's going to happen really regardless of the securities law.
Given that everybody hates filling out forms and bureaucracy, that's definitely going to happen. Yeah. Josh, thank you for the interview. Thank you for extremely insightful answers. And I'm really excited to see the complexity and all the potential for creativity that exists in the digital asset space, and cool to see professionals involved here and create infrastructure. So thank you for the interview. Thank you, Ross. And thank you to our viewers. See you in the next episode.
Yes, thank you, Ross. Thank you, Boris. It's a pleasure.